The investment committee here to get ahead of all of that. Joining me for the hour, everyone at Post 9, Josh Brown, Kerry Firestone, Jim Leventhal. Take you 12 noon in the East. We'll show you what the markets are doing today. Red across the board, as you see. Red 2 from yields, which we continue to watch closely. 472 is the note on the 10-year. So you, Josh, are real dialed in on tomorrow and the jobs report and what might happen to this market depending on what that print is.
Yeah, I'm usually the guy that comes on and says, ignore the economic data. It's already priced in. I think in this case, if we get a hot jobs report that contradicts the little bit of relief that we got from ADP in the middle of this week, I think that you're going to make new year lows in all the major indices. I really don't think there's any way around it. I really think it's if this, then that, and it's as simple as that. I wish it weren't so. I wish people weren't reacting that furiously to a monthly look at whether or not we add 80 or 90,000 jobs in an economy where 150 million people are working. But absolutely, the markets are going to be quick on the trigger. A lot of this stuff is algorithmic anyway. Doesn't even require the sentience of a human being until later on. And I think that probably dictates the next 1,000 points in the Dow. So, and what it does beyond there, I don't know. The good news is economists are looking for about 170,000 jobs. If, in fact, we come anywhere near that number, that would be below the 187 that we added in August. And I think it's doable. And I think in large part we might be helped out by the auto strikes. This might not show up in this month. Maybe that's in next month. Revisions downward would be helpful as well. The Fed, I think, is miscalculating by continuing to pound on this higher for longer, higher for longer, higher for longer. What they've basically set up is a scenario where every uptick in the 10-year Treasury means like another $1 trillion coming out of the stock market. It's really stupid messaging. I think they could calm it down a little bit. They have largely gotten their way all over the economy, and so if we get this cooled off jobs report, I think it will really help sentiment. And it's possible stocks might have seen the lows for the year if that's what we get. Keep in mind, we are very washed out. I talk about internals all the time. I want to relay to you that the RSI on the index itself, on the S&P 500, the RSI is now 32. 30 is the low for the year, which happened last week. We are now more washed out, though, last week and this week than we were during the SVB crisis when the RSI and the SPX got to about as low as 33. Are we in worse condition economically now than we were when we thought there was going to be a mass bank failure? It seems so overdone. So the fuel is there for a bounce if we get what I hope we get.
The problem, Kerry, is you've got people like BTIG's Jonathan Krinsky saying 4,200. We're, 70 points or so above that. It's not going to be the low. That too many people expect it to hold, and then you get a nice rally into the rest of the fourth quarter. But he says may not be the case. Chris Ferrone, Strategas, says yesterday's rally hardly gives you the all clear. You didn't even get 2-to-1 advancers to decliners. The internals are weak. So Barclays, we believe we have substantial room to reprice lower before bonds stabilize. That's where the narrative is now. You could say, okay, well, now everybody's getting negative, so maybe that's a positive.
Well, I think what you're hearing are the people who have been negative all along are really raising their voices, and the people who have been bullish are very quiet right now because the last couple of weeks are not playing into anything that's optimistic. I think we have to see what comes out of those job numbers, and the job numbers that we saw from ADP were lower. We know, by the way, Josh said this could be lows for the year. We could see the market come down some, but think about what's happened to inflation through the course of this year. It's continued to go lower, and it's still going lower. We had this spike in energy. Now we have less demand, it appears, and energy prices are coming down. So I think the number can well be within a range that the market will be comfortable. This has been a hiatus period. It's fine. We understand that. And frankly, I think it's time to sort of let the Fed see what the numbers are.
I'm hurrying you along because I have some news that I want to get to, and I just don't want to hold it any longer because it is causing shares of General Motors to take a big drop. Take a look at GM shares as we speak, which I saw down about 3%. intraday. There's a Wall Street Journal piece out. There you go. There's the big drop, and it coincides with this story, according to the Journal, that General Motors has at least 20 million vehicles with potentially explosive airbag parts. Again, that's according to the Journal, which also says that NHTSA, the National Highway Transportation Safety Administration, is holding a meeting right now to consider whether to order a recall over those airbag components.